The budget is done, and now it's all attention on the Reserve Bank of India's monetary policy on February 6th. Well, actually, the Reserve Bank is clouded with a lot of problems. There is the currency. There is the budget, which has given a larger borrowing program than expected. The inflation and growth numbers will change because of new series. And the world financial markets, at least, are in a tough place. As always, before the official MPC meets, CNBC TV18 Citizens MPC meets to bring us all up to speed with what we should expect. Joining me now are our members, Soumya, Kanti, Ghosh of SBI, Sajjid, Chinoy of JPMorgan, Samiran Chakraborty of Citibank, Sonal, Varma of Nomura, and the chairman of our committee, Dr. Pronab, the former chief statistician. Gentlemen, and Sonal, thank you very much indeed for your time. Sajjid, I'm starting with you. You know, the elephant in the room is Rupee. Even if the RBI argues that we set the monetary policy only on domestic matters, it's not inflation, it's not growth, but Rupee is the biggest concern. How will the MPC tackle this consistent fall in the currency?
Thank you, Latha. Good morning. So first and foremost, I think the Rupee is a symptom, right? The underlying cause is we're unable to attract, adequate capital inflows, particularly FDI flows to finance the current account deficit. So the first best, of course, would be what do you do to attract more capital, more FDI flows? Portfolio flows are welcome, but tend to be more volatile. So the focus has to be on FDI flows. Now, absent that, if that were to take time, what is the best course to react? And, there's a trade-off here. If you don't let the Rupee become the shock absorber, then you're putting a lot of pressure on foreign currency reserves to do the heavy lifting to prevent the Rupee's adjustment, right? And, if this was a temporary shock, it's perfectly understandable to use foreign exchange reserves and smooth it out. But we're seeing that, volatility around the world has become a structural phenomenon, as the economic survey so eloquently pointed out. This is here to stay. We're just in the first year of a 4-year Trump administration, and we're going to see markets whiplash. So the question is, how much reserves do you want to use? And we've used a fair amount the last 2 years. And how much do you want to preserve? If you want to preserve reserves over the next 3 years, which I think is the prudent strategy, this is an environment to build buffers, fiscal buffers, monetary buffers, FX reserves, then the Rupee has to become a shock absorber. Now, I'll say two quick things, Latha. Firstly, by letting the Rupee become the shock absorber for the external sector, it frees up monetary policy, right, to focus on domestic growth inflation dynamics. So the monetary policy only has to react insofar as that the shock absorption capacity of the Rupee translates into higher or lower inflation. In this case, it's a weakening Rupee, so there'll be higher inflation. So you've got a separation of principles here. Yep. Rupee looks at the external sector, and monetary policy looks at the domestic sector. Yep. Very final point, I'd say, given the geopolitical strategic environment we're in, a weaker Rupee will make our exports less uncompetitive versus ASEAN that have lower tariffs. It makes Chinese imports more expensive, gives our domestic substitutes a chance. So in this, it's happening against a period of benign inflation. We can agree about that. We can debate the tactics of intervention. Tactics should not induce where weakness causes more weakness. But the larger strategy, I think, is the only one we can pursue.
I take your point. These are the theoretical points. But I'm not able to buy this, our exports become competitive because 90% of our exports are value addition to imports. And secondly, as you said, as you ended your conversation, you said that it can, speculatively increase, more outflows or at least make people afraid of coming. So, Samiran, do you think in this policy, aside from the MPC itself, we will hear something like, those NRI bonds, Resurgent India bonds? Is there a need now to head-on tackle the psyche?
So, Latha, just to take a different point of view than what Sajjid mentioned, I think the key difference is that whether you treat Rupee, as Sajjid started off saying, as a symptom, or you take Rupee as an endogenous variable in the whole construct. If you take Rupee to be an endogenous variable, which in turn affects everything else through the expectations channel, then allowing for a large Rupee depreciation actually could be harmful for capital inflows. Everybody will delay their capital inflows, thinking that we might actually lose money if we bring it in now. So that's where it's imperative for the RBI to put some guardrails on this process. It's debatable to what extent the rupee depreciation actually helps exports, whether there is a J-curve effect sort of thing also. These things are somewhat more debatable. I want more sort of clarity. Every sector would be different on this front. But clearly the expectation channel is something which today has become very, very important, especially because the traditional ways in which market used to think about the valuation of the rupee using that 40-country RER, those valuation metrics are not as useful as they used to be before. Because on those valuation metrics, rupee is undervalued for a sustained period of time now without any significant improvement inside. So when does the market think that this is enough of depreciation and not anymore? So because that key metric is not being followed in a significant way, we can all debate which is the right metric of valuation, but at least some guidance needs to come on that front also, which is where I think a statement from RBI to start with that the rupee depreciation is beyond what the fundamentals suggest, I think would be very helpful. And then you can think of other measures. The only problem with those other measures is that they can bring back the memory of 2013, which is also something that you don't want to do to spook the markets at this point.
Fair point. Time permitting, I'll come back to it later on. I mean, whether we need actual steps to encourage flows. But, there is another problem that the MPC will face. Sonal, that question to you. We don't have a reliable CPI number. I mean, I don't mean it in derision. The CPI series is going to change. And therefore, how will the MPC tackle this? Your own report says that the new series could be a good 0.5 percentage point higher. So how will the MPC debate this?
Yeah, Latha, I think it's best for the MPC to wait for the new series to come out rather than prejudge what it is going to be. Now, based on the new weights that were released, where the weight of food is down by almost 9 percentage points and core is up nearly 10 percentage points in the new series versus the old series, the current regime where we have deep food deflation, it does lead to, spot CPI inflation rates that are almost 50 basis points higher than what the older series suggest. So there is uncertainty on where we currently are in terms of the inflation rate. The good news is that, under the new series, we will have a lower weight for some of the volatile food items, a higher weight for the services items. So it should be a series with less volatility and where we see lesser divergence between headline and core inflation. And I think for the, RBI and the MPC, the focus has to be on the momentum. And not just on the inflation rate, particularly as we transition from the old to the new series, because some of the transition will cause some technical adjustment. But if the momentum in the new series is broadly aligned to the momentum we've been seeing in the old series, then I think that should still lead to some optimism.
Okay, fair enough. So they can always look at the momentum, and we don't have to be worried that the end number will be higher than what the Reserve Bank forecast. It could be about 30 basis points higher is the consensus. Soumya, the other big problem that the Reserve Bank and the MPC will have to be tackled is zero transmission. Not because of their own problems, but because the end of the rate cycle and this huge borrowing program which the market was not prepared for. How do you expect the MPC and the RBI will tackle it?
Yeah, thank you, Latha. I think this transmission problem is also akin to what is the problem we are facing currently in the exchange market. I would like to delve into two parts. The first part I will address is on the government borrowing program. Yes, the numbers of the borrowing program which came yesterday are higher than market expectations. But the important thing to note is that the net borrowing numbers are almost similar to what the market was expecting. The gross borrowing has been significantly higher. And my sense is that if you look into the number last year also, the Reserve Bank did buybacks of around, the government did buybacks around 86,000 crore or so on. So if that is the same number, if that is the amount of buyback which we can see, which is announced outside the budget, so that could actually bring down the gross market borrowing. So I think this is one of the things which the market could actually understand over a point of time. So the yields actually could react to that. However, to the larger question in terms of the transmission, I think one of the big things is that the disconnect of the RBI liquidity management with the yield movement today in the markets. For example, I think the RBI has done OMO close to 6 trillion. That's a record OMO. And even then, the yields actually have not bulged a little. It has actually moved up today for whatever reasons. My sense is that at some point of time, the central bank also needs to communicate to the market in no uncertain terms. Because as you know that the central bank had communicated earlier that yield curve is a public good. And there is also the communication to the market this time that yield management is not the function of the central bank. So therefore, again, it could actually make a self-fulfilling prophecy in the market that if yield management is not the function of the central bank. Note that the central bank is actually the PD. There is no public debt management office in India.
Yeah.
Borrowing cost of the center and the states has to be managed by the RBI, whatever are the consequences. It's good. So from that perspective, I think to get over that self-fulfilling prophecy, to put the yields down, or to at least stabilize the yields, it would be very helpful for the central bank to make the OMO linked to the market microstructure in terms of the liquidity management.
Okay, so you mean some big OMO program can come. I mean, I wanted to debate more on whether we should expect the RBI to also speak about buybacks or something like that. I'll do that in a bit. We didn't discuss growth at all because the numbers looked so good. Dr. Sen, you've been there, done that, seen several cycles of growth. The survey tells us that real GDP growth for next year is going to be between 6.8 and 7.2. It's higher than the street at this point in time. And the nominal GDP is 10. So is this something the MPC doesn't have to worry about? Growth doesn't need a helping hand, would you say?
Latha, at this particular point in time, we are really in a state of flux. The Trump effect is really yet to hit us.
Yes.
And my take is that the coming year is going to be filled with uncertainty. We have absolutely no idea what's going to happen as is expected that we will start transitioning to a more rupee-based payment system. What the Indo-EU FTA will do. So there are a lot of moving parts that are there. Now, in all of this, whether we'll grow at 7% or not is not really the issue. The real issue is whether or not the sense of confidence in the Indian economy is restored. Because if you look at what's been happening to our investments, they've remained pretty much stagnant over the last few years, despite very healthy growth figures. So the question really is, can we up that? Can we make it possible for people to feel much more confident about what's going to be happening, given the situation that Trump is an imponderable in this whole scenario? We do not know what he's going to do tomorrow. It may work either way. And so the whole issue, I think, facing the RBI and the MPC is going to be that how do we position ourselves where we can move nimbly either direction?
Fair point,
because
sir.
we just don't know which way we're going to go.
Fair point, sir. There are further questions then on stance and on whether there will be rate cuts after this policy, February 6th policy. But I'll postpone that for the moment. Let me get your first vote in. The first question really is very simple. What will the MPC do on Feb 6th to the repo rate? Let me start with the lady. Sonal, what will they do?
Hold.
Hold, no change. Okay. Samiran?
Hold, no change.
Okay. Soumya?
No change.
Okay. Sajjid?
Hold, no change.
No change. Dr. Sen?
Hold.
Okay. So no change for now. But all my members are worried about several aspects, currency, growth, and the changing inflation numbers, all those questions to my guests after the break.